Understanding booms and busts in housing markets. 5 factors to consider before purchasing your next property. Factor number 1, understand market signals when investing in real estate. Factor number 2, real estate bubbles. Factor number 3, the availability and cost of financial capital. Factor number 4, estimate price appreciation. Factor number 5, deal-specific. Introduction. The following 3 forces combine to cause the boom and bust cycle. These 4 forces work together to cause each phase of the cycle. The law of supply and demand. The availability and cost of financial capital. Future expectations. Some booms in housing prices are followed by busts. Others are not. It is generally difficult to find observable fundamentals that are useful for predicting whether a boom will turn into a bust or not. Housing boom is the rapid increase in the market price of real estate property, until they reach unsustainable levels and then prices decline. This period, during the run-up to the crash, is also known as froth. Factor number 1. Understand market signals when investing in real estate. Let us discuss how we understand current market signals when investing in real estate. Some market signals indicating that all might not be well in the real estate market. A good example is the continuing upward trend of home prices. Maybe this is not the right time to buy since the boom phase is likely to soon turn to bust. The boom and bust cycle is accepted with prejudice in modern economic theory. Despite extensive research and countless theories on how business cycles and economic recessions work, all we know for sure is that one follows the other and that no one can predict with 100% accuracy when. Already we are seeing more and more first-time home buyers regretting their decision to buy a house over the previous 6 months. And, of course, if the market begins to cool, as some experts predict, you will need to know how to spot the signals and be ready to come back in for an ideal buying opportunity, one that is congruent to if not stronger than the last market correction. Factor number 2. Real estate bubbles. A boom refers to a period of increased activity within either a business, market, industry, or economy as a whole. Booms are often medium to long-term periods of economic or market growth and may eventually turn into a bubble. Bubbles in housing markets are more critical than stock market bubbles. Housing bubbles are temporary periods of months or years characterized by high demand, low supply, and inflated prices above fundamentals. Bubbles are caused by a variety of factors including rising economic prosperity, low interest rates, wider mortgage product offerings, easy to access credit. Indeed, historically, the housing market has not been affected by price bubbles when compared with other asset classes. That could be due in part to the large transaction costs associated with purchasing a home, not to mention the carrying costs of owning and maintaining a home, all of which discourage speculative behavior. However, housing market does sometimes go through periods of irrational exuberance and see prices rise rapidly before falling back in line. Factor number 3. The availability and cost of financial capital. Cost of capital is a useful financial tool for investments, with the intent to limit cost. Cost of capital calculates investment opportunity cost and maximizes potential investments in real estate. Unlike the previous subprime mortgage crisis and the years leading up to it, where big banks were the culprit, what seems to be partially driving the current frenzy is the pressure some young people feel to purchase. The historically low interest rates on many mortgages, what was once considered an impossible dream for many people, felt within reach, for the first time. Factor number 4. Estimate price appreciation. Too many home buyers use only recent price performance as benchmarks for what they expect over the next several years. Based on their unrealistic estimates, they take excessive risks. This excessive risk-taking is usually associated with the choice of a mortgage, and the size or cost of the home the consumer purchases. Recent home price performance is not generally a good prediction of future home price performance. Home buyers should look to long-term rates of home price appreciation and consider the financial principle of mean reversion when making important financing decisions. Speculators should do the same. Taking risks is not inherently bad. Taking risk is sometimes necessary and advisable. The key to making a good risk-based decision is to understand and measure the risk by making financially sound estimates. This is especially applicable to the largest and most important financial decision most people make, the purchase and financing of a home. Factor number 5, deal specific. While good deals can be found in any market, they are very difficult to find in a boom phase. When buying a property, it is key to have clear parameters and stick to them. Set an absolute limit to what you are willing to spend. Additionally, for investors, ascertain the rent a property can generate or the appreciation that can be created in the case of a fix and flip project, and a realistic selling price if you need to immediately sell the property. Do not consider buying unless you have planned for the worst case scenario and have a significant cash buffer to get you through a significant downturn. Another consideration is related to the specific market is the acceleration of rising prices. In UK, we are seeing an acceleration of rising prices. According to the Housing Price Index, average house prices increased over the year 2021, in England 7%, in Wales 11.6%, in Scotland 14.6% and in Northern Ireland 9.0%. London continues to be the region with the lowest annual growth, 2.2% for the 8th consecutive month. Understanding the structure of your local city real estate market and also location, then specific factors, is key to making good purchasing decisions. Another important consideration is related to what can be considered macroeconomic factors. Whether COVID-19, unemployment, economic growth, interest rates or demographic trends, these often play out in the real estate market. Keep reading, keep observing and deepen your understanding of all the factors at play. Furthermore, the shift in the workplace, from being immersed in an office to that of your home, perpetuated the desire for a larger space, with home amenities such as but not limited to a large home office, gym and overall larger and more practical living spaces. Keep all this in mind, and if you find the perfect deal, proceed with it. With deals few and far between in the current market, you are best served by building up your net worth down payment and getting ready for when opportunities do come. Bottom line. Do not regret buying a property, regret not walking away from a bad decision. Unlike the stock market where people understand and accept the risk that prices may fall from time to time, many people who buy a house do not really think that the value of their home will ever decrease so much. In the current boom phase that we find ourselves in, how will you know when it is the right time to buy? Nobody can tell you to wait for the next bust cycle before you buy. It is your decision. Thank you for watching the video. If you watch all my lectures, you may be able to start investing in rental properties a little quicker. Please subscribe to my channel and press the bell to get alerts when a new video is posted. Please write your comments, questions, or concerns you would like to share.